Hello, I'm Bob Goulder, contributing editor with Tax Notes. Welcome to the latest edition of In the Pages, where we take a closer look at some of the content from our print and online publications. The theme for this conversation is the prospect for federal tax reform in the year 2025. Now, that might sound like it's far off in the distant future, but in the legislative sense, really it's not, as we shall explain. Our featured article is titled The Hopefully Upcoming 2025 Tax Reform Debate. And the author is the prolific Monte Jackel, who's a frequent commentator in the pages of Tax Notes, whose analysis is always thought provoking. And we're delighted to have him here today. Monte, thank you for joining us.
Thank you for the introduction. Appreciate it.
So let's get right to it. First question is obvious. It is still 2023. Why are we talking about the prospects of tax reform in 2025? Aren't we overlooking 2024, or is it just naive to think that anything could happen in an election year?
Well, it's really the second part. Yes, it's naive. You wish it wasn't, but it is. In fact, what triggered the thought for the article from a prior article a couple of weeks back by Brian Dees and David Kamen, both in the administration at one point or another fairly recently. And they say in this Tax Notes article that they called Principles for the 2025 Debate, that reforms that plug the avoidance holes in our tax system and improve tax administration will help set the stage for future policymakers to more easily address the long-term fiscal shortfall and also help restore public trust in the tax system itself. So when I read that, I said, all right, I don't know. I'm really fond of hitting my head against concrete, but if I do it more than 2 or 3 times, your head starts to bleed a little bit. But I thought, look, these guys going to say this. I got to at least give it a try to tee it up. And the article has a lot of citations to prior articles that I've done in Tax Notes, just to lay out what I think needs to be done. So that's the reason. It's politics pure and simple. I mean, I don't, they can't even get the simplest things done, but we'll see. You never know. It could be a surprise. Doubtful though.
Your article identifies 5 possible reforms, and let's briefly touch on all of them. First, there's an issue I think people will be somewhat familiar with. It's the idea of taxing appreciated gains at the time of the taxpayer's death. And I want to clarify that this is an income tax concept, not an estate tax concept. Basically, the proposal is to treat that event as some kind of a deemed sale. Can you tell us how that would work in practice, and how does it differ from the so-called mark-to-market concept that comes up so often in these trendy discussions of, whether we're going to have a wealth tax or something like that?
The basic premise is the ambiguity in current law, because it is an ambiguity, of when the decedent's final year ends, tax year ends, which is like with the end of the year or on the last day of the year. Death itself is a disposition for purposes of the proposals, along with certain protective measures like lifetime transfers and so on. The idea would be generally one-time tax, as if you sold it on the moment of death, that would be taxable to the decedent in the decedent's final income tax return, with appropriate exemptions and monetary thresholds for when the provision would apply, which is necessary for, some for administrative reasons. The exact numbers and where things would fall out is political. But the fundamental concept would be it's a one-time tax at death. The mark-to-market system is on an annual basis, or if sooner when there's a disposition or if there's a death. So under a mark-to-market, if you enacted comprehensive mark-to-market legislation, it would include a death time transfer as well as those during life. And It's probably the best way to describe it. It's there's a lot of technical issues with such a proposal, but if it's going to be floating around, I'd recommend the more narrow approach, meaning gains at depth and more expansive mark to market, at least to see if it could be administered. But if the idea is going to be, even from the same political party that proposes it, that anything that's done, no matter what the threshold is, no matter what the um, deferred payment options are granted, no matter what, it's still destroying family farms. If the thing is passed, then it'll never get passed. And if that's the way that we're going to approach tax reform, then it just won't happen. Have to have at least a little bit of a stiffer spine than happened the last time. Excuse me, I forgot one thing, which is the pending U.S. Supreme Court case and more. If that is decided and it comes out a certain way, then imposing a tax at death would not be possible.
The next proposal is something of a related concept. It's the idea of taxing liabilities in excess of basis, again, at the time of the holder's death. Can you work us through an example of how that might work? And could you briefly touch on this idea of, is that actually something Treasury could do without legislative consent? Could they do that through regulation?
Liabilities in excess of basis is really a subset of a broader gain at death proposal, in that if you either through a partnership or directly borrow money and get tax basis for the borrowed money, and then you use that borrowed money tax basis for absorbing loss allocations that are limited to basis, or distributions that are limited to basis before a gain is recognized, you're going to end up with liabilities in excess of basis. Now, if during life you gifted the property, the law has been for many, many years that would be a taxable event. And so the concept would be to apply that at death. Now, there's also a second way you can have liabilities in excess of basis, which would be you have appreciated assets, such as, let's say, marketable stock or securities, and you borrow over a certain threshold, which is, again, a political decision, and it's treated effectively economically, it's a sale. Question is, whether you're going to tax it or not. If doing it during life, you could fully understand why you wouldn't want to do that. But at death, if the underlying asset's going to be stepped up to fair market value, there'll be no gain again when effectively it's been sold. The obligation may exist, but the gain's gone. And so the fundamental concept behind this is at least tax that. When I proposed this in 2021, it got like no traction whatsoever, which is, I don't quite understand why, although it's still vulnerable to an attack as destroying the family farm. But at least in the case of liabilities in excess of basis, you're dealing with money essentially that you've already received, or a tax benefit you've already gotten. It's not like at death where you're just looking to prevent the appreciation from escaping tax. You actually benefited from the debt basis in the case of where you borrowed and depreciated the property. The only, some technical issues you have to work out, like what can you aggregate the property that's securing the asset with other property that's owned, and how do you do that? Because the more basis you have and the more assets you count, you're going to change the calculation of whether there's liabilities in excess of basis or not. in terms of, excuse me, in terms of an administrative ability to do this, there's a lot of folks like to cite this revenue ruling 1973. I think it's 73-183. And it dealt with the transfer at death when alternate valuation date was elected, but there were no facts in there indicating that there were liabilities. So, but despite the fact that there's no indication that the liabilities were involved, some like to cite the case as supporting the proposition that you never have a gain at death, no matter what. And I'm positing that the government could, as far as I see it, there's no law to the contrary saying liability at death can't be taxed. I don't see it's the only issue is a question of timing, meaning does the final year of the season close at the same time as, or immediately before, or immediately after the property is deemed transferred? And you get into questions like that. So a statutory solution would be preferable. But the point is that it's been within the power of the IRS to do something about this for many years. And recently, in the 2023 revenue ruling that dealt with the issue of whether you got a stepped up basis for property in an irrevocable non-grantor, trust, the government, irrevocable grantor trust, but the government had facts that they stated weren't being covered, which were liabilities in excess of basis. It said there were no such things in the ruling, nor did the ruling deal with a case where you had a sale of property between the grantor and the grantor trust, which under the well-known revenue ruling 85-13, the IRS treats as not happening for income tax purposes, but it happens for estate tax purposes. So the only point is that if the issue is unclear at the present time, better for a statute to do it. But if it was stagnating for a period of time, the government couldn't do any more harm to the system than allowing such gains to be escaping the net. But I'd like to see a statute, but we'll see.
That's it for this part of the discussion. Please keep an eye out for the next part of this series with Monte Jackel. Goodbye, and thanks for watching. Want more like this? Subscribe for more tax videos. Special thanks to our executive producers, Jasper Smith and Paige Jones, showrunner and video editor, Jordan Parrish, and assistant video editor, Chris Trigo.